So these people who come in and say, look, on my read on the economy, things look like they are weakening pretty significantly. What do you attribute that to, what you see versus what they see?
Well, it's weakening from a faster growth rate. So we went up a hill, and now we're coming down a hill, but we're still way above zero. So we have 2.5 for 19, and your Candace Browning and her team have got 2.5. And
2.5 GDP.
2.5 GDP U.S. and 3.5 in the world. And so they've come down a little bit, but it's still 2.5. And you know, especially in the first half of the year, they think it's stronger than the second half because you see the slowing, and next year they're down nearer 2, a little below 2. So that slowdown is what everybody is. Last year we were talking about synchronized growth. This year it's synchronized slowdown, but it's a slowdown, not a stop. And that's what we have to be
Did your mix of businesses, was it superior to what we think of with some other big banks that allowed you to outperform, or was it you? It was great. Was it great management? Was it your people that you inspire with great leadership? Because I mean, I saw superlatives about Bank America, and usually it's not necessarily not knocking Bank America, but it was significant outperformance from the businesses you're in, or from better execution, better expense control. What was it?
I think it's quite frankly, it's a great team doing all the things you described. It's 16 straight quarters of operating leverage, growing revenue faster than expenses. This isn't like made yesterday. 16 straight quarters. The power of the core franchise, the core banking franchise, has always been very strong. The capabilities of that franchise we think are best in class because we invest so much in them. And so I think you saw this quarter, not one quarter, but many quarters. It's just got people's. But
it wasn't the yield curve. It wasn't. There's a Bank America around. Everybody's got my debit card. Everything I use is Bank America.
Thank you.
Suddenly, that's better than, dealing with hedge funds and IMDb and things like that. Suddenly, these are better businesses than some of the fees you can garner doing other stuff.
The consumer business makes about twice as much as the next biggest business, which is the commercial banking business, and then the wealth management business and markets business make about $4 billion after tax apiece. That's because the U.S. economy is big, going back to Becky's point. And so, if you think about a large economy and a large position in it and operate well, that the team does across all our businesses, and the consumer business doing very well, that's going to produce a lot of earnings.
Were you surprised by how mixed, and I'm saying that politely, some of your peers, their quarters were? I mean, it was a very mixed quarter at best.
We were happy that we were on the top of the heap, no question. That's obvious. But I think the trading business was really, the month of December was really kind of strange, and it's moved back to where it's more normal and things. But it was really a strange time. It shut down, and the confluence of things that didn't go right were high. So a lot of people had that kind of surprise them towards the end of the quarter. Going into the end of November, the businesses were performing basically on par.
Another thing, though, this is something you've been at for a lot of years and a lot of quarters. I was kind of surprised just looking at the employment for the bank right now, 205,000, which is down about 75,000 from where you were when the financial crisis took over. 205,000, is that kind of where you see employment for now? Or
it won't come down at the same rate, but you're always investing. We invest $3 billion a year in technology for better products for Joe's account and for better services for all our customers. And that obviously makes us more efficient too. So you'll see that. But we plan headcount 36 months ahead by month, by position, by everything. And the teams are working on it. Because our view is that we have to let attrition be our friend. So what happens is you're seeing a cycling. Every year we're down to 4,000, 5,000 people. But you had 2,000 or 3,000 more people facing customers and less people as we digitize and improve paper process and get rid of it. And that's going to go on forever. Now, what number of people that would be, I don't know. But you'll have a shifting of that body from one side to the other side, for lack of a better.
Before we let you go, you care deeply about interest rates. So if you were Jerome Powell, what would you do in 2019?
One of the hazards of being a bank CEO is not to second guess your primary regulator. But I'd say that I think the minutes are clear that as they reach the neutral rate, they have said we have to be careful now and watch data. We're data dependent. And that is meeting to meeting. An analogy a great economist once made to me, think of them as climbing one of these mountains, handhold to handhold. There's no path at the left. They've reached the path, and now the question is what they're going to do, and that's going to be depending on the data.
Has that, by the way, as the change in industry, I mean, now that you can get decent risk-free rate, do you think it's changing your clients in terms of their interest in investing in the stock market?
Well, when you had the market disruption, we saw a little cash move back in, but when you look at our wealth management customers, the difference is like 1% or 0.5%. It's still in the mid-single digits type of numbers overall. So the money, investors are in the market.
Nobody's buying CDs from you still. Okay. Brian Moynihan, thank you. It's nice to see
Great
you.
to see you.
Good to see you.